Hai, my name is Silvervina Echa, NIM 2210426918, kelas Accounting D. Chapter 4, Financial Statement. Learning Outcome. After studying this chapter, students are expected to be able to 1. Explain the meaning of financial statement. 2. Differentiate and classify the types of assets and liabilities. 3. Explain the forms of financial statement. 4. Understand the basis and purpose of financial statement. 5. Develop financial reports formats. The definition of financial statement. The figure 3.1 above depicts the financial statement of the collection. Financial statements are a collection of summary level reports about an organization's financial results, financial position, and cash flows. They are useful for the following reasons. 1. To determine the ability of a business to generate cash and the source and uses of the cash. 2. To determine whether a business has the capability to pay back its debts. 3. To track financial results on a trend line to spot any looming profitability issue. 4. To derive financial returns for the statement that can indicate the condition of the business. 5. To investigate the details of certain business transactions as outlined in the disclosures that accompany the statement. The standard contents of a set of financial statements are: balance sheet, showing the assets, liabilities, and stockholders' equity as of the report's date. It does not show information that covers a span of time. Income statement, showing the result of the entity's operation and financial activities for the reporting period. It includes revenues, expenses, gains, and losses. Statement of cash flows, showing gains in the entity cash flows during the reporting period. Supplementary notes, including expansion of various activities, additional details of some account, and others items as mandated by the applicable accounting framework, such as GAAP or IFRS. If a business plans to issue financial statement to outside users, such as investors or lenders, the financial statement should be formatted in accordance with one of the major accounting frameworks. These frameworks allow for some leeway in how financial statements can be structured. So statements issued by different firms, even in the same industry, are likely to have somewhat different appearance. Financial statements that are being issued to position parties may be audited to verify their accuracy of fairness of presentation. If financial statements are issued strictly for internal use, there are no guidance other than common usage for how the statements are to be presented. At the most minimal level, a business is expected to issue an income statement and balance sheet to document its monthly results and ending financial condition. The full set of financial statement is expected when a business is reporting the result for a full fiscal year, or when a publicly held business is reporting the result of its fiscal quarters. Classification of assets, debt, and capital. The composition of assets and liabilities in the balance sheet is as follows. Asset. Current asset, long-term investment, tangible fixed asset, intangible assets, other assets, liability and owner's equity. Liabilities, current liabilities, unearned income, long-term debts, other debts, other liabilities, owner equity, capital. Paid in capital, capital stock, agio disagio capital stock, reserves, retained earnings. Asset. Assets are future economic benefits that are expected to be received by a business entity as a result of past transactions. Assets have three main properties. 1. Having the possibility of future benefits in the forms of the ability, either alone or in combination with other assets, to contribute to cash inflows in the future, either directly or indirectly. 2. A certain business entity can obtain benefits and monitor these benefits. 3. Transactions that cause the company rights to obtain and supervise the benefits have occurred. Current assets are cash and other assets of sources that are expected to be realized into cash or sold or consumed during the normal business cycle of the company or within the year. Look at the figure 3.6 below. The elements included in the category of current assets are: 1. Cash is available of business now and elements that can be likened to cash, for example, checks, money orders and others. 2. Inventory of merchandise, raw materials, work in process, finished goods, auxiliary materials and spare parts used in the maintenance of tools and machinery. 3. Trade receivables and not receivable. 4. Receivable from employees, suppliers, and other parties if received them there. 5. Installment receivable and instant notes receivable. if they are common in the trade will be repaid within a year. 6. Marketplace securities which are short-term investment. 7. Costs paid in advance such as insurance, rental insurance, tax, supporting materials, and others. Long-term investment. Not current assets, which included several types of investment that can take the form securities, provisions for funds, and others long-term investment. The elements that are included in the long-term investment group are: 1. Long-term investment in securities such as stock, bonds, and long-term notes. 2. Investment in subsidiaries, including long-term advance. 3. Invest to tangible fixed assets such as land, machinery, but not yet used for business now. 4. Provision of funds for long-term purpose, such as funds to pay off bonds, pension funds, own stock purpose funds, pensions payment funds, funds building replacement, and others. 5. Cash surrender value from life insurance policies. Tangible assets. Tangible assets, also known as hard assets, are physical items with a clear purpose for use by a business to produce goods and services. Examples of tangible assets include PP&E, furniture, computers, and machinery. Business can also have non-physical assets known as intangible assets, such as goodwill, patents, and copyrights. Current versus fixed assets. Tangible assets can be divided into two groups, fixed and current. Current assets, also known as liquid assets, are either cash or items which a business expects to sell by the end of the financial year. Current assets can be sold to increase cash flow or erase debts and other liabilities. Stock is an example of a current asset, as is expected to be sold in the near future. Fixed assets are physical items that cannot easily be sold at any point solely, because these items are considered long-term investment or because they are essential for the day-to-day running of the business. Machinery and properties as example of fixed assets, as both the essential in the running of the business, so cannot easily be sold. Tangible assets in accounting. Tangible assets are initially recorded on a balance sheet at the price they originally cost. However, they will eventually move onto an income statement through one of two ways. Current assets should be organized on the balance sheet. depending on how easily they can convert into cash. With the most liquid assets coming, he gets up the document. Their current assets are used. They become part of the cost of goods sold. Fixed assets move to the income statement through depreciation, an ongoing process whereby the cost of an asset is recorded as an expense over its useful lifespan. For example, a computer lasts several years before it breaks or becomes outdated. The initial cost is spread across the predicted useful life of the computer, with some of the costs being recorded as an expense every year. Tangible assets in debitor. Debitor invoicing software helps you keep track of company assets and monitor their value over time. With debitors like response, you can enter an assets, then track depreciation over the asset's useful lifespan. Just enter an asset as an expense, mark is as an asset, the turn on depreciation. The debitor apps use straight line depreciation to break down the cost of the assets of a set number of years to make it easier to monitor the value of the asset. Intangible fixed assets. Intangible asset includes operation assets that pack physical substance. For example, goodwill is a fixed asset, as are patents, copyrights, trademarks, and franchises. A company's intangible assets are often not reported on a company financial statement, or they may be reported as significantly less than their actual value. This is because assets are accounted for their historical cost. Unlike tangible fixed assets such as building or machinery, intangible are often developed internally without any direct measurable cost, then can be capitalized when an intangible is purchased, however, or when costs can be directly traced to the development of the asset. The cost is recorded as an intangible asset on the balance sheet. Intangible asset valuation. Intangible assets are valued at their of acquisition. A proposed intangible is valued based on an amount paid for the asset. Research and development costs associated with developing an intangible are expensed for the year in which they were incurred. However, costs in registering patents or trademarks and illegal fees incurred to defend a company risk of use are included in the cost of acquisition, which is reported as an intangible asset on the balance sheet. Intangible with a determinable life. Intangible assets with a determinable life are amortized over their useful lives. Amortization is a process of allocating the expense over several accounting periods to reveal the actual amount of the asset consumed at each period. The useful life of an intangible asset is usually assumed to be the intangible asset's legal life. After the useful life will often be shorter. A patent, for example, has a legal life of 17 years, but its useful life may expire earlier than this life. A new invention makes a patented technology obsolete, intangible with an indefinite life. Many intangible assets have interminable lives. For instance, there is often no reasonable way to determine how long a company's brand will hold value. For these reasons, intangibles with an infinite life are not amortized but are tested for impairment instance. An impairment expense is recognized if the assets carrying value excess its fair value. A company should test a eligible for impairment at least once each year. Once the impairment is recognized, it is not permitted to be recovered. UAS rules in intangible assets, Section 197 of the Internal Revenue Code defines tax accounting procedures for intangible assets such as copyright, goodwill, and trademarks. These assets must be amortized over a period of 15 years, regardless of the useful life. Section 197 does not permit impairment testing, but it may allow you recognize a loss if the asset is disposed of before it is completely amortized. If you are doing a business or a stake in a business, which includes intangible assets as part of the selling price, the intangible can be amortized by the buyer only if it was amortized by the seller, and only if the transaction was not part of a series of related transactions. This is known as the anti-churning rule, designed to ensure an owner does convert intangible that don't qualify for amortization into those that do. Authors' assets. These are assets that cannot be included in the group such as deposit to sellers, to granted contracts, borrowing in progress, long-term deliverables, advance to company official and aids. Liability and owner's equity. Liabilities are defined as a company legal financial debts or obligations that are during the course of business operation. They can be limited of unlimited liabilities are settled over time through the transfer of economic benefits, including money, goods, or service. The owner's equity is simply the owner's shares of the assets of a business. You see, assets can only belong to two types of people. People outside the business who you owe money to. Debts now in accounting is liabilities. Then owner himself, owner's equity. Current liability. A current liability is an obligation that will be due with him 1 year of the date of the company's balance sheet and will require the use of a current assets or will create another current liability. However, if a company normal operation cycle is longer than 1 year, current liability are the obligation that will be due with him the operating cycle. Current liability are usually reported as a separate section of a company balance sheet. This allows readers to subtract their total from the company's total amounts of current assets in order to determine a company working capital. Giving current assets by the current liabilities is the company's current ratio. Example of current liabilities. The following are common examples of current liabilities. Account payable of trade payables. Notice payables that will be due within 1 year. The principal portion of a long-term loan that must be paid within 1 year. Wages payable. Income tax payable. Interest payable. Author's accurate expense payable. Difference revenues of customers' deposits. Revenue received in advance. Under the actual basis of accounting, revenues received in advance of being earned are reported as a liability. As the amount received in advance is earned, the liabilities account shall be debit for the amounts earned and a revenue account shall be credited. When a company receives money in advance of earning it, the accounting entry is a debit to the assets cash for the amount received and a credit to the liability account such a customer advance as on-year revenues. As the amounts received in advance is earned, the liability account shall be defined for the amount earned and a revenue account shall be created. This is done through an adjusting entry. Examples of revenue received in advance. The following are a few examples of revenue received in advance. An insurance company receiving premiums for protection during the following 6 months. A magazine publishes receiving money for the subscriber for magazines for the following year. A website design company receiving a client for payment for future works. Allow firms receiving a retainer free from a new client. Long-term liability. A long-term liability is an obligation resulting from a previous event that is not due within 1 year of the date of balance sheet or not due within the company operation cycle if it is longer than 1 year. Long-term liabilities are also known as non-current liabilities. Example of long-term liabilities. Some examples of long-term liabilities are the non-current portion of the following: bonds payable, long-term loans, pensions liabilities, post-retirement healthcare liabilities, different compensation, deferred revenues, deferred income tax, customer deposits. Some long-term debt that will be within 1 year of the balance sheet that can continue to be reported as a long-term liability if term is. A long-term investment that is subrogated and restricted for the payment of the debt or intends and a non-calculable argument that assurance that the long-term debt will be replaced with new long-term debt or with capital stock. Other liabilities. Debts that cannot be reported in the little above the reported under other titles. For example, debt bonds that are due but will be repaid from the bond settlement fund. Long-term debt to company officials or to subsidiaries and others. That may arise due to past activities are contingent liabilities. Such debt are shown in the balance sheets with footnotes. These include unformed debts, for example, discounted notes payables, legal disputes, tax, and other expense which is entertained under guarantees given. Glossary of key terms. Financial statement. Formal records of the financial activities and position of a business, person, or other's entity. Statement of cash flow. A financial statement that summarizes an amount of cash and cash equivalents. Balance sheet. A statement of the assets, liabilities, and capital of a business or other organization at a particular point in time, detailing the balance of income and expenditure over the preceding period. Income statement. A report made by company management that shows our revenue, expense, and the income or loss for a period. Asset. A resource with economic value that an individual, corporation, or country owns or controls with the expectation that it will provide a future benefit. Liability, an obligation to, or something that you owe somebody else. Liabilities are defined as a company's legal financial debts. Owner's equity. The owner's claim to company assets after all of the liabilities have been paid off. Question and answer. Based on the article of financial statement, answer to the following question in full. 1. What is financial statement? 2. Give the example of financial statement for a company. 3. Mention and explain the components of financial statement. 4. Explain the following: balance sheet, income statement, the statement of cash flow, and retained earnings statement. 5. Explain the classification of assets and liability and give their example. 6. Give the example of the balance sheet, the income statement, the statement of cash flow in a company, and give brief explanation. 7. Summary. The article of financial statement and video record is summary by using youtube.com and post it on a model. Translate the components in these figures into English. 1. Income statement. 2. Balance sheet. 3. Statement of cash flow. Grammar focus simple past tense. We use the simple past when we talk about something which started and finished in the past. We use the simple past to describe a series of actions in the past. We use the simple past read together with the past progressive gray. An action in the simple past interrupts the action in past progressive, the one which was in progress. How do we form the simple past? We form the simple past with regular verbs infinite ad. With irregular verbs, turn column of the table of the irregular verbs. Affirmative sentence in the simple past, regular verbs. I played with a ball. You played with a ball. He played with a ball. She played with a ball. It played with a ball. We played with a ball. You played with a ball. They played with a ball. Affirmative sentence in the simple past in regular verbs. I went home. You went home. He went home. She went home. Negative sentence in the simple past, regular verbs. I did not play with a ball. You did not play with a ball. He did not play with a ball. She did not play with a ball. It did not play with a ball. He did not play with a ball. You did not play with a ball. They did not play with a ball. Negative sentence in the simple past, irregular verbs. I did not go home. You did not go home. He did not go home. She did not go home. It did not go home. We did not go home. You did not go home. They did not go home. Use the auxiliary did simple past of do every time regardless the subject. Grammar sentence. Thank you.